continue our conversation about a little bit of Fed speak and no rush to cut or not. Former Federal Reserve Vice Chairman Roger Ferguson. I always say he's been the one who's been more right than just about anybody we've had on this broadcast the past 2 years about what the Fed will do next. He's former president and CEO of TIAA and now vice chairman of the Business Council, also a CNBC contributor. Of course, that is his most important title. I don't know if he's going to agree with that, but Roger, it's great to see you, sir.
Thank you. Nice to be here.
For those who are playing the market and trying to figure out the Fed's next move, are you of the view that are you in the view that this goes back to the Jamie Dimon comments earlier this year? I mean, maybe you were with him. I don't know if you were fully with him of this idea that they're just this could be the end. Is there any chance this is the end this year?
Well, look, I think no rush to cut is certainly right. I think a later start is finally seeping into the market. And in fact, 3 cuts and then we'll see. I think this is very much let's see what happens. And the reason is that this inflation dynamic has been pretty unusual with supply chain, wars, a variety of things happening that aren't usually the story. So I think they are going to be pretty cautious. And there's a real question of whether or not, inflation is going to be hanging up there. And I think they really want to wait and see. So I'm very much in the cautious, no rush to cut, and let's just let the data speak for itself.
How do you look at equities these days, Roger? Given that, we've had this sort of wild little ride in the last 2 days on the back of the NVIDIA news, but I don't know if you want to argue that the market's held up better than it was supposed to, maybe worse. I don't know.
Well, I think what Steve said is right. I think earnings are looking better and better because the economy itself is looking, to most people, more likely to achieve that famous soft landing. I think the Vice Chair Jefferson mentioned that yesterday. Others have implied it. I would also observe that interest-sensitive sectors have continued to show a bit more volatility as Fed expectations change. And so I think it's a market that's driven by many different forces depending on exactly which companies you're looking at. The indices overall, as you know, lean heavy towards tech, and hence NVIDIA and other things really are driving the so-called market. But underneath it, I think there's a little bit more volatility depending on exactly where you look.
Roger, the Fed is not omniscient. Nobody is, obviously. And we've emphasized again and again that data dependency is an important thing that the Fed uses. But would you say that maybe the Fed got a little bit fooled by how well things were going and enabled the markets to get ahead of themselves and now maybe have shifted back when the data came in strong? It's not all the market's fault, is it? We felt pretty confident 3 months. I think the Fed felt pretty confident 3 months ago that things maybe.
I think I disagree with you a little bit here, Joe.
You don't think so? They never
think
said anything. They never got out in front of this and had to take it back.
If you think most of what they've been doing has been trying to calm down market expectations. Now, they've called the data as they see it, but I don't think that they were, feeding this frenzy. And remember, the last time the Fed officially had, something that might be called, an outlook or a forecast was the so-called dot plots, which said 3 cuts in 2024 and left the impression probably, back-ended. So I think the Fed's been pretty consistent on its outlook. It's reflected, the movements of the data a little bit. And so I think more of this has been market enthusiasm than it has been Fed, feeding expectations inappropriately.
Roger, curious if you want to weigh in on this as somebody who just thinks about productivity, because we've been having conversations almost endlessly about NVIDIA and endlessly about AI and what it really means. And I think a lot of people are trying to figure out what's going to happen. Are you of the view in the sort of the economic camp that we're about to go through some kind of massive productivity boom that's going to be fabulous, a boom that's going to take away jobs? What do you think is supposed to happen here?
So if you look at the history of new technologies, I'm going to use the word, they do all of the above. So first thing is you have to adopt them. I've been impressed with how quickly some companies have been adopting, AI and really changing the way they do things. Secondly, there are going to be some jobs that are lost. That's always the case when you have new technologies, right? So think about agriculture. There was a point when most people worked in agriculture. because of productivity improvements. You only have now 1 or 2% of the society working in agriculture. Point three, I think we'll become more productive as a society as we adopt these new technologies, which has generally been the case.
I guess, is this
once we adopt
1984? Is this 1996? What is this?
Well, maybe it's none of the above. So I think we're going to see very industry-specific move towards increased productivity. That is going to lead to some layoffs for sure. I think this one feels real, though, Joe. I'm sorry, Andrew. It doesn't feel to me as though this is just all hype, because I've seen a number of companies that actually are using AI. I'm hearing it from the CEOs that I survey and talk to. So I think this one, I'm cautiously optimistic that while there will be some job cuts, we are going to see a much more productive and much more efficient economy. Not going to be good for everybody. Going to be good, accurate overall for the macroeconomy, and it's going to depend on new sets of skills that all of us are going to have to learn.